Well, hi and welcome. My name is Casey Boland. I'm a wealth advisor with HCM Wealth Advisors and CPAs. I'm joined today by Doug Johnson, who's our senior investment strategist, and Dan Rinck, who's a research analyst with HCM Wealth Advisors as well. Welcome to our webinar. Now, if you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have the opportunity to submit your question. And this panel will do our best to answer at the end of our webinar. So, guys, it's March Madness. How's everybody's bracket doing at this point in time? I think for most people, I think that your brackets are busted. To win, you have to successfully pick 63 games in perfection. And I don't think it's ever been done in history. ESPN had a great article about someone a couple of years ago who picked the first two rounds, and it had never been done before accurately, and then their brackets started to fall apart. So, why do you talk about it? Well, similar to investing, when you're playing your brackets, it's fun to have the Cinderellas. It's fun to have the upsets. So you think about upstarts and companies, or you think about AI as an example. So something Dan's going to talk in a little while about artificial intelligence, and AI seems to be everywhere. So imagine that, there's lots of stocks or teams you could pick from. And let's say this was in the stock realm, and similar to March Madness, you're going to pick an AI company or pick a group of AI companies. There was a great article by Jason Zweig in the last 2 weeks in the Wall Street Journal. And he did some research, and he looked at there are 17 ETFs, exchange traded funds, that specialize in AI stocks or some type of opportunistic, something that it has to do with the market, but something with AI or disruptive market investing. Anyway, surprisingly, this is shocking. As much as AI has been in the news and how well AI has done, only 3 in the last year have outperformed the S&P 500. So similar to March Madness, if you want to win, it's so difficult to pick the winner. And that's what happens in the stock market of investing as well. It's so difficult to pick a single winner. It's why diversification is so important. Okay, all right, moving on. So now we're going to talk about returns, and this is going to be, I think, a very interesting chart that we're going to talk about. And the reason we're going to touch on this particular chart is some of our dialogue is going to relate to valuations and where are stocks nowadays. And as we look at the stock market, we see this chart that shows a period from 2000 to 2009. So before we dive into this data, I'm going to ask you a question. And the panel knows it, so I can't ask them to jump in and give me an answer. But if we look at the last 30 years, so if we go back just before 2000, you look at the last 30 years of this U.S. stock market, and you say, which area of the U.S. stock market has performed the best? So you can choose from large company stocks, mid-sized company stocks, or small cap companies. And I think the most common answer for people would likely be large cap, which, believe it or not, was in last place of the three. It didn't do badly, performed at 10.1% average, but small cap and mid cap performed better. Mid cap was at the top. It averaged 11.2%. So how does this happen? Well, when you look at a chart like this and you have a period of time from 2000 to 2009, large cap stocks, they can stumble. They've been fantastic in the last decade. Well, you had a decade during that 30 years in this particular time period from 2000 to 2009, and they really stumbled. They actually had negative performance during that 10 years. Mid-cap stocks were up over 60%. Small cap stocks were up 85%. And foreign, something we don't like to talk a lot about because foreign has really struggled in recent years. Foreign actually did much better than the S&P 500 as well. So when we look at this, were there any clues that the market was offering that could have tipped one off to see the coming weakness during this decade of those large company stocks underperforming? And I think the answer is yes, but It's not always as simple as that. So as we move to the next chart, we're going to start focusing and looking at valuations. So when we look at valuations, this chart shows how valuations have changed through time. When you're looking at the last 12 months, so that LTM in the chart, that's what that means. And we're going to look at the S&P 500, which is that the large cap stocks, it's the navy line, and the S&P 400, which are US mid cap stocks in light blue, and the S&P 600, so those are small cap stocks in the US, and that's the gray line. So if we go to the beginning of this time period, the year 2000, we see stark differences in PE ratios. So the PE is being the price of a stock divided by the earnings of a company. And a PE can help determine if a stock is overvalued, it's a higher number, versus undervalued or fair value, where you've got a lower number. And back in 2000, you can see here, large caps, they were almost double the PE of mid cap stocks, from almost just under 30 to close to 15 for mid caps. And we just viewed the chart before showing the significant outperformance of mid cap and small cap stocks versus large cap stocks during that period from 2000 to 2009. When you're looking at this chart, it appears that valuations, in fact, did provide a clue that large company stocks, maybe they were set to underperform. Is it as easy as this? Not necessarily, because what you don't see with this picture is if you went back a couple years earlier, from 95 to 2000, leading up to the beginning of this chart, large caps still were overvalued for quite some time, but yet they continue to outperform small and mid cap stocks during that time. So we fast forward to the last couple years. Small and mid cap now, they're undervalued, but they've been underperforming large cap stocks by a substantial margin, even though they are in fact undervalued today. So large caps, they've got a PE of almost 23, while small and mid companies, they're in the mid-teens. And as we look at this, we do in fact see that we think small and mid do provide an opportunity in the coming years to potentially outperform, but that trend just hasn't happened yet. We've seen some periods where small and mid have started to do a little bit better, only to give way to large company stocks. So we are waiting patiently for this opportunity. Let's move on though. So the S&P 500, and I'm going to talk a little bit again about PEs because I just talked about this, but PEs and the dynamic of PEs, they change over time. So you have to really take that into account, because if you're just looking strictly at PEs, you'd say stocks are pretty expensive now when we looked at that last chart. But the S&P 500, yes, even though it's statistically expensive since 1900, you have to question the validity of comparing today's S&P 500 valuation to history, given there's been many changes in the index's makeup over time, from asset light, healthier attributes of old company economic sectors to renewed focus on efficiency. Elevated valuations relative to long-term averages are one of the primary reasons that there are a lot of strategists out there on Wall Street still are conservative about how they think the near-term stock market potential, what's going to happen. But if we look at the S&P, and if we say the S&P 500 today is apples, you've got to look at the time periods in the past and say the 80s, 90s, and other periods are more like oranges, because there's a lot of factors. One is, if you look at leverage, the S&P 500 is about half as levered now. It's higher quality, and it has lower earnings volatility. And when you're looking at this particular chart, you can see that the S&P 500 index, it gradually shifted from 70% asset intensive manufacturing, financials, real estate companies, that's that yellow bar and teal bar in 1980, to now you go over to 2024, and you see now that 50% of the makeup is asset light tech and healthcare. That's that purple color tied to innovation here. So the companies in the S&P 500 today are just better by most measures. They operate with much more flexibility than companies in the past. You've got lower debt levels. The mix of the shift of the S&P now is shifted more toward nimble asset-like companies. And these companies are getting a whole lot more out of their workers, so much more operating efficiencies as well. And by the way, it's not just company fundamentals that have improved. You've got trading costs have come down substantially, which is another element that argues, for higher premiums in stocks also. So none of this suggests that PE ratios are worthless. However, you can't look at a single PE metric and say this is going to reveal everything you need to know whether or not it's a good time to buy or sell, especially in the short term. Valuations really don't tell you much about the next year. Certainly longer term, there's something we want to be clued in on, and we're keeping an eye on that. But small and mid, as we said, may provide an opportunity. So in thinking about those opportunities, this chart, I think, really starts to outline that lower interest rates that could really help improve small and mid-cap companies, as a significant amount of their debt is floating rate debt, meaning as interest rates have gone up, the interest rate borrowing those dollars associated with corporate debt for small companies has gone up on approximately about 50% of their debt. Large cap companies, and you can see the chart, they have fixed rate interest rates on more than 90% of their debt. That's like having a 3% mortgage rate in a 7% interest rate environment. That gives you a huge advantage. So if we see interest rates go down in time, small companies should see their earnings accelerate. And speaking of earnings, let's go to the next slide. So on the left side of this particular slide, we've got two charts here. Much of the focus in recent months has been on the Federal Reserve. But if you ask me what is the most important driver for stock prices in the long run, it's earnings. And as you can see on the chart on the left, stock prices and earnings have moved together. Over time, they just kind of intertwine and move, and they're very strongly correlated to together. On the right side, you're going to see the expectations for forward earnings. That's more of a recent snapshot, and expectations continue to march higher. Now, we might be in store for a pullback with stock prices soon. We don't know. And maybe analysts eventually find reasons to cut their outlook for earnings. But even if that happened, you look at these intermediate developments on monetary policy, interest rates, that may spark some type of gyration in stocks. But for now, the big story, though, is you look at this chart on the right, the outlook for earnings is extremely bullish. Earnings growth matters more to stock prices than the Fed policy does over the long term. And when you look at this particular chart, I think it's very indicative, hopefully, of a strong outlook for the rest of the year. But I'm going to hand that over now to Doug and Dan, and they can give you a better perspective from an economic and some other areas of the market that I think will give you a better picture as we see what the rest of 2024 may hold.
Yeah, of course. So Casey mentioned small and mid as kind of a possible opportunity, and part of that being, the leverage to rates. The big theme that we've heard from the Fed has been, where is inflation, and has it gotten to a point where the Fed can eventually cut rates and move off of the 5.25 Fed funds rate that they've had now for roughly 16, 18 months. So here we can see the CPI year over year change going back to February 22. And this was kind of right in the middle of the ramp up. June 2022, you have a ceiling here of 9.1. Subsequently, that was one of the first kind of bottomings in the market that year. The second was in October. But as we've seen inflation slowly come down, you've seen stock prices increase. What we've seen since July of last year is kind of a flat line of the CPI. So it's come down, but once it reached that 3% mark, it's kind of bounced around within 1% of that number. And if you remember, the Fed's target for inflation is right around 2%. So they're taking a look at this and saying, okay, at what point do we feel comfortable going ahead and lowering that Fed funds rate and easing financial conditions a little bit? Now, again, you can see this in another version here. So the inflation target, or the inflation numbers, have definitely remained above that 2% inflation target for the time being. Not only that, we've seen over the past 2 months, we've seen headline CPI numbers on a month-over-month basis that have come in slightly higher than expectations. Now, when we say slightly higher, we're talking about the difference between, a month-over-month number being 0.4 instead of 0.3. So not massive jumps, because the year-over-year numbers actually keep slowly coming down. But those came as a little bit of surprise to some people, and I think it gave the market a little bit of pause, in the sense that, okay, is the Fed going to be able to cut rates this year? And if they can't, because inflation is staying a little bit more stubborn than thought, how is that going to affect asset prices? Well, even as recently as the beginning of the year, or even February, you had the market pricing in almost 100% chance of the Fed cutting rates 25 basis points in June of this year. And as these colored lines start to move lower, it just represents the potential for those rate cuts, is represented by kind of market odds. So these top two lines, the red line represents the July Fed meeting, blue is June, green would be May, and then the brown one is actually March, which we've already passed. But you can see the progression from even the end of last year, where there was almost a 90% chance, at least the market was pricing in, 90% chance that the Fed was going to cut rates 25 basis points this month. And we can see how that number's come down quite drastically. And really at the time of this chart, which was before the Fed meeting, that had gone down to almost 1%. So we can really see how the kind of movement of odds of rate cuts really are affected by what we see in the month-to-month CPI reports. But even with those numbers coming in a little bit hotter than expected, what's the Fed's own forecast? Well, here you can see that their projections for the Fed funds rate in December of this year still are 4.6%. And that hasn't changed substantially. So if Fed funds rate right now is at 5.25, and the Fed's own projection, even with these inflation readings, comes in at 4.6, there still has to be, roughly 75 basis points of cuts there, or 25 basis points cuts. So a lot of that is being projected, I think, into the end of the year. Maybe we start to see our first one in July, but I think, the question that some investors have is, are these CPI reports pushing that schedule back? And if it does, how is that going to affect risk assets, specifically things like small cap and mid cap, which right now, maybe they've already priced in those 3 rate cuts, or they haven't priced them in yet, and there's room for them to increase when those rate cuts actually take place. So, as we look at the actual market, stocks versus bonds, and we can see the reaction here. So, you have the 10-year Treasury rate kind of peak close to 5% in November or late October of last year. And ever since rates have come down in the bond market, it's been pretty much a straight line up in equities. But here we can see some volatility in the rate market with the 10-year Treasury. And this was all based on, especially this move up, was based on the very first CPI reading that came in a little bit hot, and had investors saying, okay, maybe inflation's a little bit stickier than we thought. Maybe the Fed's not going to be able to cut rates, and bond rates rose, but it had really no effect on the equity market at all. As you can see, that this is the S&P 500 just continued to kind of march up in a straight line to the right, while 10-year Treasury rates kind of pinged around that 4.25 range. So even with the minor concern of the possibility of inflation being stickier and the bond market reacting to that, we're still not seeing rates move anywhere near where they were back in November. And even the Fed themselves is saying we're still going to cut rates at least 3 times by the end of the year. Now, again, these forecasts are very dynamic, but I think it's interesting that we're seeing the market respond in a positive way, even with a little bit of concern that inflation might be a little bit stronger than people expected. And then finally, I think, to put some historical perspective around it, where is the neutral rate going to end up? Neutral rate is kind of the rate that the Fed would like to stay at, where they feel they're not being too restrictive, but they're also not in a position to let inflation kind of get out of control, so to speak. So it's interesting to see different time periods and what the neutral rate was. I mean, we go back to the 1990 to 2000, the neutral rate was close to, or at least the 10-year rate was close to 6%. And then you've got the 3-month Treasury bill, which we use for the Fed funds rate. It's close to 5%. So a much higher rate regime than we've seen over the past decade. Then you get into the 2000s where you get two periods of, we'll call them significant bear markets, one being the tech boom right at the beginning of the decade, and then obviously the great financial crisis in 2007. But even throughout that, the 10-year Treasury remained right around that 4% level, while the Fed funds rate was dropped substantially to try to stimulate the economy. And then from that, you had the QE period where rates were basically zero. You had 10-year Treasuries at 2%. So the question now is, are we going to go into a new rate regime where the neutral rate is going to be much similar to what it was in the early 2000s? And if so, how will that eventually affect risk assets? I think that question kind of remains to be answered. But when we think about rates today, and we say, if the 10-year Treasury gets to 5 or 6%, that's outrageously high. Looking in historical context, it's really not. I think it's just we had such a long period of low rates that investors kind of gravitated their benchmark to that when in fact we could be entering a regime where that rate is a little bit higher. So inflation remains I think the number one focus of the Fed, and I think if they're cutting rates slowly and not doing it because we're seeing economic stress, I think that's a good sign. And we very well could see that soft landing that I think 12 to 24 months ago everyone thought was highly unlikely, and ultimately is going to be positive for risk assets. Now we talked a little bit about AI earlier, and the kind of AI craze, and you can see it all over the place now. Here's a picture of a toothbrush, of all things, a toothbrush, but it's got AI. So Dan, do you think now that toothbrushes even have AI, that we've maybe gone a little bit too far with this AI craze?
Well, I mean, does it brush my teeth for me? That's the real question.
I mean, I figure now with the electric toothbrush, that's kind of what those things do, but maybe this is something crazy we don't even know about.
Yeah, absolutely. There's no doubt that AI is going to have a pretty significant impact on a lot of companies, but we're starting to see a little bit of mania there where anyone and everyone is slapping AI on the front of their website or on their boxes. And the media will tell you that this whole entire market rally has been driven by artificial intelligence, by the craze of AI. But I'm going to present some data that says a little bit otherwise, that the stock market as a whole is a little bit stronger, and it's not really anchored by that AI like everyone thinks. So just kind of a recap on where we've gone for the last few months. We've had a pretty strong rally since September, October. And we have some data here saying that strong rallies throughout the end of the year and the start of the year usually lead to pretty good numbers for the rest of the year. This chart right here shows S&P 500 performance when it's higher November, December, January, February, and March. So one would think initially, hey, we've had a huge rally. There's no way it can continue going. But looking back through history, this data goes back to 1950. There's a lot of things to be positive because throughout history, when you've had those really strong periods, the S&P 500 continues to trend for the rest of the year. So looking at this chart, it shows the next month, April, when we've had those very strong periods. And those numbers are pretty much on par with the S&P 500 during a normal market environment. Q2, pretty much the same, an average return of 2.9%, and an average year for the S&P 500 returning 2%. But now the rest of the year, 9 months out, is where the numbers really get interesting. So for the final 9 months of any average year for the S&P 500, the average return is only 7%. The median return is 7.6%. But when we have that strong fourth quarter and strong start of the first quarter of the next year, for the final 9 months of the year, the average return for that period in all these instances is 11.9%. It's almost 12%. And then the median return is 11.2%. So that's a pretty statistically significant number. Now we only have, it looks like 12, 13 instances there. But when we're looking back through history and looking at these numbers, we don't need to be as fearful thinking that something has to break, there has to be a bubble pop. Throughout these periods of strong returns, a lot of times it can continue through the rest of the year because economically it's supporting those prices. Then another chart is basically showing that breadth is continuing to expand. This chart shows the S&P 500 performance after 118 or more new 52-week highs. So you have over 20% of the S&P 500 making brand new 52-week highs, so year-long highs. Instances where this happens, the 12-month return going forward is positive 100% of the time. The median return through that period, the next 12 months is 7.8. And then the average return, when you get some of these huge breadth numbers, over 20% of the S&P 500, not just the top, 5, 6, 7 stocks, you have 20% of the S&P making brand new 52-week highs. The average return is 12% over the next 12 months. So we're getting some numbers showing us that it's not just AI driving this. It's not just NVIDIA. It's not just the largest companies in the world driving all the stock prices. It's starting to broaden out, and you're starting to see participation throughout the rest of the market. And if we look back from the bottom in since October, we can see that it's not really just the S&P 500. So on this chart, we're showing the S&P 500 and the S&P 500 equal weight index. So the S&P 500 is a cap weighted index. It takes all of the money and pulls it based on how large the company is. So the larger the company, the larger allocation to the S&P 500 it gets. The S&P 500 equal weight index takes all 500 of those stocks and divides them equally and charts them as an index. So as we're seeing, the blue line here is the S&P 500, and it's rallied, as all the media types will tell you, is just driven by the top 7 stocks in the index. Well, in the orange is that S&P 500 equal weight index. So you have 500 names bundled together in an index, barely trailing the S&P 500. So what that tells me is it's not just the top stocks driving all the returns. You have a very large participation from the rest of the constituents in the S&P 500. So if we go into the next chart, this shows specific sectors within the S&P 500. So when we look at things, we like to look at it through, valuation sectors, a lot of different metrics to show us if a rally is strong or if it might be weak or rolling over. So this chart shows 3 sectors that we like to watch that are economically sensitive. So the XLY index, which is consumer discretionary. So when the consumer has extra money, they typically go to these places like a Home Depot, and I think Tesla's even in there. If you have excess money, that's where you spend the money. It's those companies. Then you have XLF, which is financials. and then you have XLI, which is industrials. So these three sectors are typically very economically sensitive. So if the economy is not doing well, you can typically look at these sectors and they'll tell the story. Now you have the XLY, which is consumer discretionary, XLF and XLY, XLF and XLI, starting to get a lot of their constituents making 52-week highs. So we're seeing 30% on XLY. We're seeing close to 40% on financials. And then industrials, even, we're close to 40% as well. Companies that are building things are reaching all-time highs because their earnings, as Casey spoke to earlier, are driving higher stock prices. And this really just speaks to, again, the breadth of this rally in the S&P 500. And again, it's not just the top 5 stocks, it's not just the AI stocks. It is economically sensitive, very important sectors of the economy continuing to increase in price and put in good earnings and driving the S&P 500 forward. So if we go to the next chart, one thing that is interesting and a little concerning is a lot of people don't even really touch on this anymore, but the yield curve is still inverted. So the yield curve is typically one of the most solid recession indicators you can find. Whenever there's an inverted yield curve, a recession follows. Not only does the inverted yield curve signal a recession, it a lot of times causes a recession. Now, this chart shows the streaks of trading days with an inverted yield curve on the 10-year to 3-month. So as you can see right now, we're at 210 trading days in a row of the market having an inverted yield curve. Now, if we look at some of the other large instances, you have the 80s, you have the tech bubble, and you have the great financial crisis. We're not going to ignore this, but I think this speaks to a little bit about how strong the economy has been to continue driving these prices. We've been talking about recession for the last year and a half, 2 years, it feels like, and it seems like it just continues to be pushed out. And that's because we're seeing a lot of economic resilience, but we have to make sure that we're being vigilant because this is something we just can't ignore. We're not saying it's going to happen in the next 3, 6, 12 months or whenever. It's just something we have to pay attention to, because typically when the yield curve reinverts or normalizes, there's typically a recession that follows. Now, it could be a shallow recession. We could even have a soft landing and completely avoid it, but it's definitely something that we are paying attention to. So keep that in the back of your minds.
Thanks, Ian. So just a quick rundown on positioning, and then we'll get into some Q&A. So we remain overweight equities. We've been in that posture in tactical portfolios since the beginning of this year, or I should say late last year, fourth quarter of last year. And then we also continue to be overweight U.S. stocks versus international. We've continued to transition cash to fixed income. In certain instances, we've talked about this a little bit, with the anticipation of the Fed eventually cutting rates. When they do that, those money market rates will start to come down. And as we look at where rates are for longer term fixed income, we've tried to take advantage of locking in some of those elevated income levels for longer periods of time. If the Fed does have to slash rates aggressively at some point, we want to be able to lock that income, and we've continued to do that. So we've mentioned small and mid cap setting up for a second half push. I think a lot of that will be dependent if inflation kind of stays under control or even moves lower, and the Fed is able to slowly cut rates. I think that will set the stage for a small or mid cap push in the second half. Our portfolios own both small and mid, but if we start to see them break out, that could be an opportunity to increase those weightings. And then finally, all eyes remain on inflation. I think that's going to drive a lot of Fed policy and ultimately drive a lot of what we might see in terms of sector leadership and what areas of the market might lead. Casey did mention that earnings, continue to look extremely strong on the whole. But I think the one, major wild card in all this is if inflation starts to ramp up unexpectedly, I think that might put a little bit of a damper on the market and put the Fed in a really tough spot. But as of now, that's certainly not something we're predicting, and we're not necessarily seeing that in the data either. So I saw a question come in here. This is a question regarding the Buffett indicator. So client read an article on the Buffett indicator. It was now at 190% suggesting near market bubble. How our portfolio is being reflected for the possibility of a significant pullback. So the Buffett indicator is basically the market cap of the entire stock market divided by GDP. So another way to look at it is, what's the replacement cost of everything that's in the economy versus what GDP readings are. So, not to get too technical into this, but I think, Casey talked a lot about valuations earlier, and I think this falls a lot into the valuation camp. And there's no denying that the data is, on the, what I'd say, higher side, or certainly in what they would call bubble territory, in terms of its own history. But I think it falls in the valuation camp, and the fact that, valuations and this indicator, I would say, are not necessarily good at predicting short-term market movements. It's more along the lines of what's going to happen maybe over the next 10 years. So put simply, if we look at valuations now and we would conclude that they were overvalued, you'd say that, historically that would mean market returns over the next 10 years are going to be below average. Are they going to be 1% below average, 5% below average? Are we going to have 10 years in a row that, the return is below average? Are we going to have 4 years of really good returns and then, 6 years of really bad return? So it's important on how that path looks. But, as Dan mentioned on the last slide with the inverted yield curve, it's certainly something to pay attention to. And I think there's a lot of things that are in the market right now on a longer term basis that, you could look at and say, yeah, there's some concern there. Now, how do we deal with that in tactical portfolios? I mean, we have a very objective kind of method in order to not only reduce risk in our portfolios, but also to increase risk. So it's not one of those things where I think we wake up one day and you say, today's the day. I have a feeling things are going to get bad. We can feel like things are going to get bad, but unless we see it in kind of the playbook that we have and that we've used, we're not going to plan for something that's maybe not happening. So, but if we did run into recession or we did start to see market internals deteriorate, we would not hesitate to reduce risk in portfolios at that time, just like we've done in the past. So it's kind of a long answer, but I think that the important point there is viewing some of those indicators as not necessarily short-term trading tools, but more of long-term possibilities. Casey, Dan, anything you guys want to add to that?
No, I mean, I think, as you mentioned, it's similar to our discussion a little bit about PEs. Things change over time, and it's hard to compare one environment necessarily to another. And and you have to look at a lot of different data points. And there's some other models out there that certainly have also suggested that the market may be a little overvalued. So Robert Shiller has what's called a CAPE ratio, and it looks at 10 years of adjusted earnings. And so it's good because you can look at it through an economic cycle, both up and down, to get a perspective of how valuations are. Or Greenspan came up with a Fed model. And so there's lots of different models like this. And so we don't necessarily focus on one, but there's certainly a lot of different data points that we evaluate. One big driver certainly that you could say is a headwind for market valuations has been higher interest rates. We came from a period of ultra low rates, and rates have gone up over time. So that's a little bit of a headwind for equities when you think about, I have this risk-free option available to me. But earnings, as we've seen, again, the outlook for earnings is very strong. And certainly that's going to be a driver that we're focused on. But as Doug mentioned, we have some objective indicators that we use that help give us some guidance in increasing risk and decreasing risk at times in portfolios also, and we won't hesitate to do so.
One more question, kind of a general one. What is our opinion on how the election might affect the market? You will not be surprised this is not the first time we've got this question. So I'll try to keep this answer as short as I can. I saw a really good quote the other day, and I think it encompasses this perfectly. People care about elections, markets do not. I know that sounds crazy, but if you look at the data in terms of performance under different market regimes or different political regimes, either being split Congress, Democratic president, Republican president, total control, whatever you want to look at, the market has been up under those scenarios. I know it'd be easy to point to the current environment being maybe extremely politicized, and I wouldn't disagree with that. But if you look back to the kind of beginning of Trump's presidency up to now, so you've had roughly half of that period with Trump, half of that period with Biden. The market's up roughly 150, 160%, give or take. Half of that's been under Trump, half of that's been under Biden. So I think it's easy to fall into the trap of believing that, one guy is worse than the other. We all have our opinions on that, and I don't think we need to share those here. But from an objective standpoint, we don't see the election being a main distraction and the potential for a rally. Unless there's something unknown, there's some kind of policy that comes out, there's some social unrest after the election or something along those lines. But for now, we're not seeing it as a major concern.
We have a lot of data, a lot of charts, a lot of material on this specifically. So maybe the next town hall will just be the election town hall.
Yeah, I think one of the research strategists that we subscribe to, I think, came out with something like a 25 or 26 page election report and split this every single way imaginable. So if anyone's interested in looking at that, I'm happy to give it to you. But I really think the conclusion is simple in the sense that markets perform regardless of what elections might look like. Now, when we get into next year, in terms of election cycles, then we're looking at, a different set of return profiles, but we're not there yet. So I think everyone just, needs to sit tight there and know that, yes, we're paying attention to the election, but it's certainly not something where we're going to be proactive in doing anything drastic in portfolios. So I think that's all the questions we have. So Casey, if you can go ahead and take us out.
Yeah, so today is March 27th, and tomorrow it's a special day in Cincinnati. March 28th, it's opening day, and there's nothing like it in Cincinnati. So opening day, hope springs eternal. We're hopeful for a great season here for the Reds. So thank you for the trust and confidence you've placed in HCM. And we know that you've got a lot of choices, so we're very appreciative, and we do not take that lightly. If there's anything that we can do, please don't hesitate to reach out to us or one of your advisors. We're glad to discuss your individual plan and even glad to help out with family members. Would love an introduction. So have a great evening and go Reds.